Hi everyone, I'm Oliver Kollofski, Director of Wealth Services here at Sweet Financial, and today on behalf of the advisory team of Ty, Amber, Lynn, and Brian, I'd like to take a few moments to share a concept with you that we receive a lot of questions about, and that concept, well, it's long-term care. So the questions from folks like yourselves are often something like, well, with escalating healthcare costs, what's the best way to address this risk? Or I've heard long-term care insurance is really expensive, is that true? Or I know I should have a plan, but what if I end up not needing it? Well, we typically ask, well, if you did in fact need care, let's say home health care, what asset would you envision using first? The answer is oftentimes a very conservative investment or simply cash, which makes sense. So there are two problems here. Traditional long-term care is expensive and you get nothing back if you end up not needing it, and yields on cash are really low. So here's an idea to reposition some cash to better protect yourself and your family. And the nice thing here is it's really simple. So let's use $100,000 for example. So it goes into a fixed account and earns a rate of return of 3%, let's say. So after 1 year, it would be $103,000. And then let's also say you immediately have a long-term care pool of $200,000 or $300,000. So that'd either be a doubling or a tripling here. And that's right on day one. If you happen to need long-term care, you get to tap into these higher dollar amounts there. But there is a fee for this, and it's let's just say it's 1.5%. So if you don't in fact get 3, you subtract out the 1.5% fee, and you get 1.5%, which is still pretty attractive and probably more than you're getting on your cash right now. Plus, it's tax deferred. That 1.5% interest would be tax deferred. So this is it's really a great way to mitigate long-term care expense risk and still earn a nice rate of return on the cash. Now, here's an important note. This is best suited for investment dollars you don't anticipate ever needing, with the exception, of course, of long-term care. So I've got a little disclosure I have to put in here. So long-term care insurance or asset-based long-term care insurance products may not be suitable for all investors. Surrender charges may apply for early withdrawals, and if prior to age 59.5, may be subject to a 10% federal tax penalty, in addition to any gains being taxed as ordinary incomes. And of course, we would go through all of this with you if you had an interest in learning more. So the point of this here is not to go in depth on a particular product or anything, but rather make you aware that there are vehicles out there that can help address financial risks such as long-term care. So please contact us if you would like to learn more or how it would apply to your situation. Thank you.